Veolia Environment's SA, VOEY, represents a compelling investment opportunity positioned to capitalize on mandatory structural growth within the global ecological transformation sector following the successful financial integration of Suez. The group has effectively transitioned from a period dominated by M&A integration and rapid deleveraging into an accelerated, high-margin organic growth phase encapsulated by its Green Up 2024-2027 strategic program. The core investment thesis is predicated on two structural factors. First, demonstrated operational superiority resulting in superior earnings quality, and second, material undervaluation relative to specialized environmental service peers. Veolia has completed its immediate post-acquisition deleveraging, reducing its leverage ratio to 2.63x by year-end 2024, comfortably below the strategic target of less than 3.0x. This achievement, combined with structural efficiency gains, $398 million in 2024, and accelerating synergies, underpins a commitment to achieve approximately 10% annual growth in current net income through 2027. The current last 12 months LTM enterprise value to EBITDA, EV/EBITDA multiple of approximately 7.6x trades at a significant discount both to Veolia's own historical median, 8.2x, and, critically, to the specialized environmental and waste services sector average, 11.77x. This discount is expected to compress as the market re-rates Veolia from a general multi-utility status to a specialized ecological solutions provider, particularly as the high-margin Green Up boosters contribute materially to profitability. 12-month price target derivation. A justified multiple re-rating toward the group's historical median and partial sector convergence, targeting an 8.5x EV/EBITDA multiple on projected 2025 EBITDA, suggests material upside potential. This projection is corroborated by the current analyst consensus average price target of $18.50, representing a potential upside of 12.19% from a recent closing price. IB summary of key financial and strategic metrics. The 2024 fiscal year marked a significant inflection point, showcasing management's ability to deliver high-quality earnings while stabilizing the balance sheet. Group EBITDA reached $6,788 million, reflecting robust organic growth of 5.8%. Current net income group share was $1,530 million, demonstrating outstanding growth of 14.6%, notably above the annual target. Strategically, the group is on track to realize cumulative synergies of $530 million from the Suez integration by the end of 2025. Looking forward, the Green Up program sets ambitious targets, including achieving over $8 billion in EBITDA by 2027 and maintaining the leverage ratio at or below 3.0x. These commitments solidify the expectation for sustained earnings accretion and capital discipline. IB, Business Overview and Structural Positioning in Ecological Transformation. IA, Strategic Positioning, the Circular Economy Moat. Veolia operates at the intersection of critical global macro trends, climate change mitigation, resource scarcity, and increasingly stringent environmental regulation. The group has explicitly positioned itself as a central facilitator of the circular economy, a model based on three principles: designing out waste, keeping products and materials in use, and regenerating natural systems. This positioning creates significant competitive barriers. Veolia services extend far beyond traditional municipal water provision or basic waste collection, focusing instead on advanced processes like optimized waste treatment, wastewater reuse, production of energy from household waste, and hazardous waste treatment. As governmental bodies and industrial clients face intensifying regulatory pressure, particularly in Europe, the mandatory demand for specialized, compliant solutions generates stable, high-value, long-term contracts for Veolia. This structural alignment with mandatory environmental and regulatory compliance serves as a sustainable source of demand and protects the group's operational footprint. 2B. Veolia's core operating segments and structural resilience. Veolia's operational structure is defined by its balanced exposure across water, waste management, and energy. This diversification strategy provides significant structural resilience, mitigating risks associated with commodity price volatility or localized regulatory shifts. The 2024 results underline the robustness of the group's core environmental services. Despite facing adverse effects from commodity price normalization in the energy segment, the group achieved overall organic revenue growth of 1.5%. The detailed breakdown reveals that the energy segment experienced a deep organic revenue contraction of -10.7% in 2024. However, the group's overall EBITDA demonstrated remarkable resilience, achieving 5.8% organic growth. This strong performance, despite commodity headwinds, demonstrates that the group's core water plus 5.6% organic growth and waste plus 6.4% organic growth are structurally superior in terms of stability and margin protection. The earnings base is stabilized by high contractual protection, including favorable price effects amounting to plus 175 million, 1.5% in Q1 2025, largely driven by tariff indexations and price increases in the water and waste activities. This validation of the effectiveness of Veolia's diversification is a critical de-risking factor for investors, as stable, non-cyclical utility earnings prevent macro-level commodity price normalization from undermining overall profitability. 3A. Revenue and EBITDA dynamics. The 2024 fiscal year concluded with $44,692 million in consolidated revenue. This performance was underpinned by a group EBITDA of $6,788 million, reflecting successful operational execution and an organic growth rate of 5.8%. The strong operational performance translated directly into margin expansion. The group's EBITDA margin improved substantially, rising from 14.4% in 2023 to 15.2% in 2024. This margin expansion was driven by two key efficiency levers. Operational efficiency programs. These yielded gains of $398 million in 2024, exceeding the annual target of $350 million. This consistent operational overdelivery provides strong management credibility regarding the realization of future targeted savings and reduces the perceived execution risk associated with the $350 million annual efficiency embedded in the Green Up plan. Suez synergies. The integration of Suez contributed $120 million in synergies specifically in 2024. The fact that efficiency and synergy targets were not only met but exceeded confirms that the gains are structural, offering a high degree of predictability for the group's profitability trajectory. 3B. Net income and EPS trajectory. The profitability metrics demonstrated acceleration in 2024, confirming the benefits of efficiency and integration. The current net income group share reached $1,530 million, marking a growth of 14.6% compared to the previous year, significantly exceeding management's annual goal of $1.5 billion. Analysis of the diluted net earnings per share, EPS, provides the strongest financial validation of the post-acquisition strategy. EPS has trended steeply upward across the merger period, rising from €0.09 in 2020 to €0.53 in 2022, €0.69 in 2023, and reaching €0.76 in 2024. This multi-year trajectory of rising EPS confirms that the increased profits from the Suez assets are substantially overcoming the interest servicing costs associated with the acquisition debt. This validates the core hypothesis of the transaction, confirming that the Suez acquisition is materially accretive to shareholders. 4. Strategic growth and integration value realization. 4A. Suez integration, the financial launchpad. The successful integration of Suez provides the crucial financial launchpad for Veolia's next phase of growth. The group has consistently delivered on its synergy targets. By the end of Q1 2025, cumulative synergies had reached €460 million. This performance keeps the group perfectly in line with its raised objective of achieving €530 million in cumulative synergies by the end of 2025. These operational gains are primarily realized through optimization in purchasing and strategic consolidation within water technologies activities. Deep dive into the Green Up 2024-2027 strategic program. The GreenUp 2024-2027 program is the core organic growth plan designed to accelerate ecological transformation and pivot Veolia toward higher-margin, specialized businesses. The strategy is backed by an extra €2 billion capex investment focused on specialized services. Strategic Boosters Focus. The GreenUp program identifies 3 strategic boosters, specialized areas with high returns driven by urgent regulatory and industrial needs. Water technologies and new solutions, focused on deployment of solutions for depollution, decarbonization, and resource regeneration and reuse, addressing immediate water availability and safety issues. Hazardous waste treatment, essential for managing complex industrial waste, limiting environmental impacts, and ensuring client regulatory compliance. Local energy and bioenergies, focused on providing sustainable solutions, optimizing operations, and turning wastewater into affordable, clean energy sources to help clients decarbonize industry. These specialized investments ensure that Veolia is allocating capital to segments where demand is mandatory and regulation-driven, thereby securing robust returns on investment. The successful realization of Suez synergies serves as the internal financial source funding this GreenUp expansion. This establishes a virtuous cycle where integration efficiencies pay for new specialized capex, $2 billion extra, ensuring that the targeted 10% net income growth is funded internally rather than through potentially dilutive equity raises or excessive debt increases. V. Capital structure, debt management, and risk. VA, detailed breakdown of total debt and deleveraging success. Managing the significant debt incurred during the Suez acquisition was a primary focus for Veolia management. As of year-end 2024, net financial debt, NFD, stood at €17,819 million. Total debt was approximately $19.96 billion, comprising $17.89 billion in long-term debt and $2.08 billion in short-term debt. The group has successfully prioritized deleveraging, reducing the net financial debt to EBITDA leverage ratio from 2.74x in 2023 to 2.63x at year-end 2024. This reduction is a significant de-risking achievement for an infrastructure stock, placing the leverage ratio well below the long-term strategic target of less than 3.0x. Dropping the ratio below this threshold substantially improves Veolia's overall credit profile, reduces its weighted average cost of capital (WACC) over time, and provides critical flexibility and capacity to execute the €2 billion GreenUp capex plan without incurring excessive borrowing costs or violating leverage covenants. Debt servicing capacity remains adequate, with an interest coverage ratio reported at 3.17x. VB, interest rate risk analysis. Given the high volume of total debt, approximately $17.8 billion NFD, Veolia is materially exposed to fluctuations in global interest rates. While details on the specific split between fixed and floating rate debt in Veolia's portfolio are not explicitly disclosed in available financial materials, it is a standard practice for large corporations to manage this risk through a blend of instruments. If the current debt mix were to lean heavily toward floating rates, the current environment of elevated rates could place pressure on the 3.17x interest coverage ratio. Effective hedging and a high proportion of fixed-rate debt are essential for maintaining stable profitability during the aggressive GreenUp investment cycle. VC, management of regulatory and environmental liability risk. Veolia's operations are inherently exposed to regulatory and environmental liability risk, particularly through the handling of hazardous and non-hazardous waste. Improper handling can lead to serious pollution and catastrophic business liability. Veolia management views environmental compliance not merely as a cost center, but as a strategic imperative and competitive advantage. The company's governance is structured around a committee dedicated to monitoring environmental issues, ensuring adherence to applicable laws, and widely disseminated rules of ethics. As environmental regulations, especially those stemming from the EU Green Deal, become stricter, Veolia's specialized expertise and stringent compliance focus convert regulatory pressure into a market moat. By controlling the complete hazardous waste treatment cycle, Veolia limits environmental impacts for its industrial clients, shifting liability management from the customer to the specialized service provider. 6A. Comparative Valuation Analysis. Veolia's valuation currently presents a bifurcated profile. It trades at a premium based on equity multiples compared to traditional European utilities, yet at a steep discount when measured by enterprise value multiples against its true sector peers in specialized environmental services. This discrepancy signals a potential for significant multiple expansion. 6A. Enterprise Value Multiples. The LTM EV/EBITDA for VEOEY is approximately 7.6x or 7.09x on a USD basis. This multiple is substantially undervalued relative to comparable specialized groups. The median LTM EV/EBITDA for the broader environmental and waste services sector is 11.77x. Veolia's valuation has historically been penalized due to high leverage and uncertainty surrounding the Suez integration. The EV/EBITDA of 7.2x in 2023 and 6.8x in 2024 reflected a period of intense balance sheet pressure and integration risk. However, with the leverage issue largely resolved, 2.63x NFD/EBITDA, and the strategic shift toward high-margin green-up boosters, the fundamental rationale for this discount is eroding. The stock should command a multiple re-rating, likely back toward its 5-year median of 8.2x, and eventually converging partially toward the high-growth environmental services sector average, offering significant inherent upside. 6B. Equity Multiples, PE and PEG. In terms of traditional equity valuation, Veolia's TTM/PE ratio of 17.3x confirms its position as a higher growth utility, trading at a premium compared to European multi-utility peers such as NGE, A2A, IRE, HEON, EON, which average 13.4x. More compelling is the forward PEG ratio, non-GAAP, calculated at 1.04. Given the group's expectation for approximately 10% annual current net income growth through 2027, a PEG ratio near 1 is highly attractive. This suggests that the market is not fully pricing in the robust earnings growth acceleration, especially when viewed against higher PEG ratios seen in U.S. utility peers like Ameren at 2.56 and DTE at 2.53. The low PEG ratio implies that VOE's growth potential is currently available at a reasonable price. 7. Shareholder Returns and Dividend Sustainability. 7A. Analysis of Dividend Policy and Growth. Veolia maintains an attractive dividend policy, reinforcing its appeal as a defensive, income-generating infrastructure asset. The current dividend yield is strong at 5.05%. For the 2024 financial year, the proposed cash dividend was €1.40 per share, representing a 12% increase over the previous year's dividend, $1.25 for 2023. The management has formally linked future dividend growth to the robust growth in current EPS. This aggressive dividend increase, coupled with the explicit growth linkage, is a clear signal that management possesses high confidence in the sustainability and acceleration of their post-integration earnings trajectory. For institutional capital, offering a 5% yield combined with a promise of approximately 10% growth, in line with the projected current net income CAGR, makes Veolia an exceptionally compelling investment for investors requiring both steady income and growth. 7B. Payout and Coverage Assessment. The sustainability of the dividend is confirmed by cash flow metrics. The dividend amount is adequately funded by internally generated cash flow, even after accounting for significant strategic investments. The dividend and capex coverage ratio is 1.20x. Furthermore, the company reports a low dividend payout ratio of 1.11%. Although this low figure may be based on a specific calculation of diluted net EPS, the 1.20x coverage ratio provides a more relevant measure for cash distribution capacity, confirming that the dividend is safely covered by net free cash flow generation, which stood at €1,156 million in 2024. 8. Conclusion. Veolia Environnement SA has successfully navigated its transformative phase. The integration of Suez has provided structural efficiencies and structural cost offsets necessary to launch the Green Up high-growth strategy. The group's financial resilience is confirmed by superior 2024 operational performance, over-delivery on synergy and efficiency targets, and the critical reduction of the leverage ratio to 2.63x. The investment thesis rests on the material disparity between Veolia's demonstrated earnings trajectory, targeting circa 10% CNI CAGR, and its current market valuation. The LTM EV/EBITDA multiple of circa 7.6x substantially discounts the intrinsic value of its specialized, regulation-driven water and waste businesses compared to the environmental services sector average of 11.77x. As the Green Up boosters drive a higher proportion of revenue from specialized, high-margin activities, and the market fully acknowledges the successful deleveraging, a multiple re-rating is anticipated. An eventual re-rating towards the group's historical average of 8.2x is highly probable, offering immediate valuation upside concurrent with the expected 10% annual earnings growth. Key upcoming catalysts. 9M 2025 Financial Information Release, scheduled for Thursday, November 6, 2025. This release will provide critical confirmation regarding sustained organic growth and margin trajectory through the third quarter. Final synergy confirmation, achievement and confirmation of the €530 million cumulative Suez synergy target by year-end 2025. 2026 annual results, scheduled for Thursday, February 26, 2026. This report will offer the first full-year validation of the capital deployment and returns from the initial phase of the Green Up strategy.